Vetri Subramaniam joins us. Let's take our conversation forward. Vetri, good morning. Good to have you back. Vetri is looking rough, and it's been tough at least in last couple of days. Has the market turned? Are we coming out of that regime of low volatility, high return to high volatility, low return? Has the template changed for the market?
Well, I mean, the market never gives you an advance announcement, Nikunj, so that's very hard to know. But, I would just reiterate what we've been saying to most investors, and this goes back all the way into 2024, is that, given the kind of valuations that we were trading at and given the sort of outlook, given the way bonds were trading, the best way to ride out the volatility would be to sort of look more at hybrid solutions. And as you know, we offer a large number of hybrid schemes. The industry does as well. And that's really, where we think the sweet spot currently is for all the reasons that, we can talk about in more detail later. So I think a little bit of that momentum, which kept stock prices running maybe beyond what fundamentals justified, particularly during the middle part of 2024, I think that is now coming back to roost.
Okay. So, Vetri, where do we go from here? What could be the next trigger? Could it come from global market, which is dollar, crude, or could it be in local interplay of inflation, interest rates, and earnings?
I mean, I tend not to think about it in terms of triggers, Nikunj. The fact of the matter is, we are in currently a slightly weak patch in terms of economic growth. I think certainly there will be some improvement that should come through in terms of growth in the second half of the year. We see that in some of the forecasts as well. But I think the bigger challenge really is that we've got a market which is particularly in some pockets, I would say the mid and small cap pocket, very elevated in terms of valuations. And what do elevated valuations mean? They essentially mean that those stocks are trading on expectations of very strong earnings growth. Now, you come back to reality, look at the data or the expectation in terms of GDP growth for March 2025, it's less than double digits. GDP growth for the economy is below 10%. Now, when you look at an economy which in nominal terms is growing less than 10%, and then you see that the expectation in terms of earnings growth for the Nifty, not too aggressive, maybe 14-15%, but expectations for mid and small caps going closer to 18-20% plus. How do you get corporate profit growing at such elevated levels when underlying economic growth is running just about in double digits? And when you look at exports, they're not growing very, dramatically either. So I think that is really the challenge that we face today. I think when the valuations sort of work their way through these rich levels to more reasonable levels, I think the market will sort itself out.
So, Vetri, how much more of a decline are you anticipating? Because valuation-wise, we still haven't eased off a whole lot.
I don't have a specific number on it, but if you look at the large caps, interestingly, they're richly valued, but they're not exorbitant. In fact, I would say with the recent fall, they've actually entered the fair value zone. Now, the fair value zone is a fairly large zone, doesn't mean it can't come down further. But at least the large cap valuations are somewhere in the fair value zone. The bigger challenge is in the mid and small cap. But if you were to just ask me even about the Nifty, the long-term average valuations are still 10% below. Doesn't mean that the market needs to go there. But the way to think about this, Aisha, is really to ask yourself, are the valuations at a level where I want to increase my equity allocation? And I think over there, you have not reached a valuation level as yet where you would start to consider raising your equity allocation. And which is why our preferred strategy tends to remain focused in the hybrid space.
But Vetri, you can never time the market to the T, right? So when that point will come, I guess the bounce would be so swift that you won't be able to catch the bottom really. Where is it that you at least sense that we're getting into a fair value, like you said? And where do you think that earnings pessimism is at its peak? And let's talk about large caps. I'll come to the SMIDs in just a bit.
Sure. So, if you think about it from a sectoral level, I think the area where I have the hardest difficulty in sort of parsing what the valuations imply is really in the entire industrial space, because this sector is now trading at multiples the like of which we have not seen in a very long time. And again, we're not really seeing the kind of pickup in the investment cycle that we could have hoped for. I think the part of the investment cycle which is showing some decent signs is real estate, but the rest of it not really. So I think industrials I would point to as a place where I'd be very concerned about the elevated valuations that you're paying for companies. Banking, financial services space is somewhere where the valuations are a lot more reasonable. I think one setback in the core banking space has been the multiple interventions which have happened have sort of slowed credit growth a lot more than we would have expected. And secondly, there is certainly some stress in household credit, but I still think the overall setup there in terms of what you're paying for is reasonably attractive. And therefore, that's the one sector that, we'd be a lot more comfortable about. And just to the early part of your question, Aisha, what I would say is, I think the SIP is therefore the best way when you're thinking about how not to time the market, right? So keep going with those systematic investment plans. But every investor will at some point need a thought process about how they want to handle their asset allocation. On that singular point, I would say the time to raise equity allocations has not yet come.
Vetri, good morning. This is Shrishti also joining in. But Vetri, we are just a few days away from the budget as well. So help us understand that this time, what are your expectations from the budget announcement? Any sectors that you are keenly watching out for? Because Vetri, there was some hope that maybe in the second half of this fiscal year, the capex might pick up. For now, we are not just seeing that shaping up that well. So given those hopes, seems like they're shattering. But from the upcoming budget, are you still pinning some respite on that front?
Well, to be very fair, Shrishti, I think budgets that made a very material difference to equity markets, those are the budgets I remember in the first 10 years of my career. So for that, you would have to go back to the 90s and the early 2000s. I would actually submit that we make a lot of noise about the budget, but it really doesn't affect our investment outcomes in the way that, the noise comes about which sector is impacted positively or negatively. Remember that anyway, the entire scope of indirect tax changes has moved out of the budget and into the GST Council. So nobody tinkers with, the excise duties because that's moved to GST. So, that takes away a lot of the impact that sectors used to experience. Now you're down only to direct taxes. And over there, I think the big simplifications have already happened. Corporate tax in 2019 and income tax over the last 2 to 3 years. So I would say the budget is increasingly a statement of fiscal affairs. The key element of this budget, I think, will be continuity. The finance minister has already reiterated a commitment on the glide path to a 4.5% fiscal deficit. But I think we need to understand what this means. Bringing down the fiscal deficit is great from a macroeconomic point of view in terms of stability, not so great for growth. So when you look at why is the Indian economy slowing or punching slightly below its capability, you have to look not just at monetary policy, but also at fiscal policy, because both of these are restraining the economy. And the final point, which I think which is restraining the economy, is the interventions which have happened in the credit growth. So I don't have any great expectations from the budget in terms of tweaking the trajectory of economic growth, but certainly keeping the macro discipline is very important. Because remember, we are dealing with a very uncertain world in terms of economic policy, financial stresses, and finally trade policy and a new regime coming in the US. So the best that you can do is keep your house in order, which gives you the optionality to respond to challenges as they come along.
Now come to Smiths, because that's where you're seeming a little alarmed about valuations. What are the pockets of exuberance where you think the bubble's going to burst just any time?
Well, the thing about bubbles is you always know them only post facto. It's hard to call them in real time. But again, I just think about where our valuations elevated. I pointed to industrials as one of them. The other area where I would be quite worried about the valuations, as I said, is that in aggregate, small and mid-cap valuations are not just expensive relative to their history, they're also more expensive than large caps. I've seen this in my career happen in the mid cap space, going to a premium to the large caps. And mind you, that has always been reverted. Unusually, we're also seeing it in the small caps. Then I look at the earnings forecast, going into 25 and 26, more importantly, and you've got all the small and mid cap companies in aggregate growing significantly faster than the large caps. And then I look at the reality of the economy growing at 10% nominal growth, and I'm finding it very hard to see how the aggregate of 150 small cap companies, mid cap companies, and 250 small cap companies is going to grow its earnings at 18 and 20% in that kind of a backdrop. There could be a few companies that will do it, and I'm sure some of them will do it, but the aggregate number is concerning. And therefore, if you ask me which are the pockets I'm concerned about, small and mid cap as a theme, and industrials as a sector.
Tell me about this, NFO of yours, UTI Quant Fund. Do you think that's best positioned right now? Like you said, keep it flexi cap, keep it hybrid, make best use of the volatility via SIBs?
Sure, interesting question. The Quant Fund actually builds on something we've already been doing in our multi-asset fund going back to March of 22. So we've built the Quant process. Really, it is what we call an integrated approach, because we mix the quantitative rules based on factor investing with our bottom-up research capabilities. I wouldn't really point to it as being particularly attuned to the current phase of the market, but it is an adaptive investment strategy because it responds to what market signals are telling our models in terms of what is likely to do better. And in that sense, it's very different from the traditional active strategies that we run because it is adaptive to what the market signals are telling us. I think about it as an all-weather strategy because it plays across the entire market cap spectrum, and at the same time it responds to market signals, which we don't necessarily do in some of our other active funds. So we think about it as a strategy which you could obviously look at through a SIP, and think about it in terms of all weather. So momentum driven markets which hate momentum, which are more favorable to quality, maybe more favorable to low volatility companies. This is a fund which is willing to grow across the spectrum and pick what it thinks will do better.
Okay, interesting. And for those of you watching this interview, it closes on the 16th of Jan. But Vetri, always good having you on the show. Thanks for your time.
Thank you.
If you like this video, then like, share and subscribe to ET Now.